For many, the world of real estate investing is a constant source of anxiety. We see charts, headlines, and economic indicators, and sometimes the sheer volume of information can be overwhelming. The fear of a looming housing market downturn, the concern about rising interest rates, or the lingering uncertainty in the global economy often paralyzes potential buyers and seasoned investors alike. This emotional reactivity leads directly to the single most common and costly mistake in real estate: trying to time the market. Waiting for the perfect bottom or the ideal peak often results in a missed investment opportunity. The consequence: a profound sense of financial regret, knowing you stood on the sidelines while others built wealth, or worse, sold at the worst possible moment. This isn't just about small losses. It's about forfeited gains, the erosion of potential equity, and the emotional toll of watching your financial goals slip further away. The constant property search stress, the agonizing over decisions, the what-ifs, these are all symptoms of an approach driven by short-term sentiment rather than long-term strategy. But what exactly drives this pervasive mistake, and how can we break free? Real estate markets, like all asset classes, are inherently dynamic. They experience periods of growth, stability, and correction, fueled by a complex interplay of economic forces. When a property auction boom captures headlines, it often represents a peak in market exuberance. Buyers, fueled by FOMO, the fear of missing out, rush in, driving prices even higher. Conversely, when the market seems to dip, a different fear takes hold: the fear of further losses. This leads many to attempt a market timing strategy, believing they can precisely predict future movements. For the solo investor, this is an immense challenge. Battling against ingrained human psychology and the constant stream of often misleading information makes rational decision-making incredibly difficult. Legendary investor Howard Marks speaks of the market cycle pendulum. It swings between euphoria, where prices are inflated by greed and despondency, where fear causes undervaluation. The biggest mistake is buying at the peak of enthusiasm and selling at the depth of despair. If we look back at any historical housing boom, you'll see a clear pattern. The sharpest gains were made by those who invested early, often when public sentiment was lukewarm or even negative. Economic news headlines and media narratives constantly amplify market emotion. They often sensationalize downturns and celebrate bubbles, pushing the pendulum further in one direction or the other. However, a simple look at a real estate market history chart over decades reveals a consistent upward trajectory. Despite countless booms and busts, the underlying trend of property values has always been positive. Yet, we see financial herd behavior time and again. People follow the crowd, buying when everyone else is buying and selling when panic sets in, even if it defies logic or historical precedent. It's precisely during an economic recession, when property values appear bleakest, that the greatest opportunities often emerge. But only the disciplined few are willing to go against the prevailing narrative. To truly succeed, we must move beyond the emotional noise and focus on macroeconomic indicators. These underlying fundamentals, like population growth, job creation, and housing supply, dictate long-term value. Understanding global market interdependence helps us recognize that local fluctuations are often part of larger, interconnected trends, requiring a broader perspective than just our immediate surroundings. Crucially, comprehending interest rate policy and its impact on borrowing costs and affordability is paramount. These policies can significantly influence buyer demand and property valuations over time. The smart investor relies on meticulous market data analysis, seeking out undervalued assets and understanding long-term potential, rather than chasing fleeting trends. The greatest battle isn't with the market itself, but within ourselves. Investor cognitive bias such as confirmation bias or loss aversion, can cloud our judgment and lead to irrational decisions. This is often compounded by financial herd behavior, where the comfort of following the crowd overrides independent thought and strategic action. Breaking free requires conscious effort and a commitment to data over dogma. Consider the vacant commercial property, a symbol of economic stagnation that often arises when investors, driven by fear, retract capital rather than identifying new opportunities. For homeowners, making reactive decisions can lead to crippling mortgage stress, especially when rising rates or unforeseen circumstances combine with a market downturn, leaving them vulnerable. The most painful realization is seeing property value depreciation, a direct result of buying at the peak or selling at the trough, simply because emotion overrode calculated strategy. In extreme cases, these missteps can lead to a forced home sale, dissolving years of hard-earned equity and leaving lasting scars on personal finances and peace of mind. But perhaps the greatest unseen cost is the missed investment growth. The steady compounding returns that long-term investors realize are often lost by those who jump in and out of the market. The antidote to market timing is a disciplined, long-term approach, harnessing the unparalleled power of compound interest. Let your equity grow year after year, indifferent to short-term market swing. This requires robust financial planning, ideally with trusted advisors who can help you define your goals, assess your risk tolerance, and develop a strategy tailored to your journey, not the market's whims. Building a diversified real estate portfolio, including different asset types and locations, can mitigate risks and stabilize returns, ensuring that one market's dip doesn't derail your entire investment. Consider a property renovation project to add intrinsic value, creating equity through smart improvements rather than relying solely on market appreciation. And for consistent cash flow, explore rental property income. This provides a steady stream of revenue, helping to weather market downturns and support your overall financial stability. Every successful investment begins with rigorous real estate market research. This means analyzing local demographics, economic forecasts, supply and demand, and growth projections, not just today's headlines. A thorough property inspection is non-negotiable. Understand the asset you're acquiring inside and out, identifying potential issues and evaluating its true condition and future potential. Seek out a professional mortgage consultation. Understanding your financing options, interest rates, and loan structures is just as crucial as the property itself. And ensure every detail of your real estate contract is meticulously reviewed. A solid agreement is the bedrock of a secure and successful investment. When these steps are followed, your investments contribute to and benefit from the steady, inevitable city skyline growth and broader economic prosperity. You're not just buying property, you're buying into the future. By resisting the urge to time the market and instead embracing a strategic, long-term approach, you transform from an anxious observer into a confident real estate investor. This discipline unlocks true long-term investment growth, where your assets appreciate steadily, building substantial wealth over time, independent of daily market fluctuations. The ultimate reward isn't just financial. It's the security and joy of family home ownership, the peace of mind knowing your investments are sound, and the legacy you're building. This leads to genuine financial prosperity, allowing you to achieve your life goals and secure a future of stability and abundance, freed from the emotional roller coaster of market timing. At Keystone Property Advisors, our mission is to empower you with the knowledge and real estate advisory to avoid these common pitfalls. Let's navigate the market together with strategy, not emotion.